Hi everybody, David here. I hope you're all well. Thought it'd be a good time. Had a little bit of volatility in the market to give you an update. Yeah, we've had about a 5% correction in the market so far this year. Really since September, the first week of September, we've had this kind of pullback and kind of a meandering sideways. And I was doing some homework, and last time we had a 5% correction, which was the 13th longest streak ever for the market not to correct at least 5%, was back in September and October last year, where the market was actually down in September about 7%, in October around 5 to 6%. So right now, pretty garden variety, pretty normal pullback, not even correction. Really, technically, a correction is 10% or more. Based upon the pros out there. But that's I'm not concerned right now. Yeah, there's lots of headwinds that are happening. There's no question. You have the debt ceiling issue. You have the infrastructure bill. You have China, which has been an issue with this whole project, their housing projects. I think a $200 billion potential loss. Lots of things. Inflation is an issue. So let's take a couple of these at a time and talk about them. So first off, the good news, at least there was some debt ceiling relief. I think it was October 7th that there was an agreement by the Republicans and Democrats to fund the government at least through December. So that's a good thing. That's kind of one of many things that probably needs to be taken care of. I think a bigger issue right now is definitely the Federal Reserve. They're talking about tapering, which means reducing the amount of stimulus that they're giving the economy. I think right now it's $120 billion a month. They're buying in corporate and U.S. Treasuries and those types of bonds. And so this first week of November, the Federal Reserve is meeting again to discuss this. It's most likely they're going to start reducing their purchasing of these bonds, which creates less liquidity. So that's to me is one of the bigger factors, because in the end, liquidity drives markets, meaning that if there's money pouring into the system, it's going to have a direct impact and correlation to asset prices, whether it's stock markets, real estate markets, which we've all enjoyed the benefits of that. So that's a big piece for sure that we'll be watching. That's going to create more volatility going into the first week of November at a minimum. And then, of course, you have the infrastructure bill. There's already been a $1 trillion bipartisan agreement, but the Democrats want $3.5 trillion. That is a whole other story. Kind of the good and bad of that is the bad part is, I think, is if we do pass the $3.5 trillion, that kind of creates more, obviously more debt for the country, higher taxes, but it probably does give another boost to the market going forward. $1 trillion, maybe not so much. No matter how you stand on that, I think it's kind of the least of two evils. But the fact is that the Democrats are in control of both the House, Senate, and the presidency. And they have the votes to do it. There's a couple Republicans, including Joe Manchin and some others, that are kind of standing in the way of that $3.5 trillion. So we'll see what happens. That's another big piece to this whole fourth quarter. You've seen GDP go all the way from the double-digit level after the recovery. Now, probably in going to the fourth quarter, we're talking 2 or 3% GDP growth. So definitely come off a lot. So yeah, I'm concerned for sure about really this market pushing up a lot higher from here relative to what's happened over the last 18 months. But as long as you have the Fed still behind, this liquidity drive, even if they do cut back in some of the purchasing of these other bonds and other type of instruments, the market should probably have a floor underneath it. The bonds are another story. Bonds have been very, very volatile. You've seen long-term Treasury bonds drop because of this whole tapering threat about 5% just in the last month. So that hasn't helped a diversified portfolio of stocks and bonds, because both have fallen pretty precipitously. So above and beyond that, that's a lot already. If you have any questions or concerns or thoughts, just reach out to me and give me a call. Take care.